In the world of stock trading, it's so easy to get overwhelmed and lost in the endless abyss of information that's out there. There's free ebooks, paid courses, and scammy YouTubers.
Here in my garage, just bought this knowledge.
It's extremely hard to decipher what's good information and what's bad information. As someone who's had to go through the exact same scenario myself, I found it extremely annoying. So that's why I'm making this exact video. So you can cut out all the bullshit and get a complete A to Z guide on how to start trading stocks if you're a complete beginner. Now, I'm not gonna do the usual YouTuber approach where I wrap this all up in a nice little bow and make you pay $299 for my course. The best part of this series, it's completely free.
Free.
Now, after trading for around 8 years, I can say there's a lot of information we have to swim through. My job is to go over that information in a simplistic and efficient way so you can understand the maximum amount of information possible in the shortest amount of time. That's the goal, at least. Now, there's a specific question I get asked almost every single day in the comment section from new traders. Trader after trader asking the same exact question. And that question is,
how much money do I need to start trading?
and my answer might just surprise you. Is it $100? Is it $1,000? Is it $10,000?
My God.
What if I told you the answer is $0? Let me explain. One of the biggest mistakes beginner traders make is they just instantly jump in the market with their life savings without any experience at all. Just because they saw some stock TikTok trader in front of a Lambo and thought, hey, that looks fun. Considering they have no experience, they lose all of their money, then end up saying, maybe this isn't for me. Then end up quitting and never try to trade stocks again.
I quit!
And the sad part is, this is what happens to the majority of traders. What I'm about to tell you is how you can completely avoid that altogether so that doesn't happen to you. There are devices called trading simulators or paper trading, which is basically a platform where you can trade with fake money so you can test things out. Test different strategies, test your risk management techniques, test controlling your emotions, or maybe you want to test out different trading styles like shorting. Most new traders skip this step entirely, and honestly, it's the most crucial step out there to becoming a successful trader. That's why I'm listing it as my very first step. There are a lot of different trading simulators out there. Some are paid, some are free, but the one that I would recommend the most is Weeple's, just because it's free and they have a really user-friendly dashboard to where it's not really confusing and it's really easy to use. And I really like their name, Weeble. Weeble. So that's what I would recommend if you want to try one out. Plus, I think they give you 12 free shares of stock or something like that if it's your first time signing up. So that's a good bonus as well. I'll leave a link in the description if you want to try out their trading simulator. No, this video is not sponsored by Weeble. I just recommend them if you don't have a trading simulator already. But Weeble, if you're watching this, so what I would recommend doing is getting on Weeble, start paper trading, and just do what you would normally do if it was real money. But the trick is you have to act like this fake paper trading money is real. Act like it's your actual capital. Put the concepts that I'm about to teach you in this video series to the test. But not only that, take it a step further. Record every single trade you take. If it was a losing trade, write down what you think you did wrong. Did you get greedy? Did you move your stop loss? Did you let your emotions get the best of you? Did you follow your rule set? Record everything for every single trade. The more, the better. This will exponentially speed up the process of you becoming a better trader. But not only that, you should record all your winning trades as well. Write down what you think you did right. That way you can look back at it and try to repeat the concepts you did right. When first starting out, you should not be focused on the money aspect of trading at all. You should purely be focusing on your trading strategy, improving said strategy, and trying to learn as much as possible. If you do all of this, the making money part will just come naturally. Doing just this one simple step will let you pass hundreds of thousands of new traders on the learning curve. This tip in itself is a game changer. I'm serious, every new trader should do it. That's my first step on how to start trading stocks as a complete beginner. I was thinking about making this a video series where we go completely from A to Z on how to become a successful trader. This is going to include everything: risk management, trading psychology, chart setups, market structure, candlestick patterns, trading strategies, everything.
First things first, we need to go over some common trading terminology, lingo if you will. Us traders have these common vocab words that mean specific trading terms. It's almost like a secret handshake in a way. But if you're a new trader, you definitely have to know what these terms mean, especially if you're gonna watch this series, because I'm gonna say them all the time. First term is long. To put it very, very simply, when you're long on a stock, that means you make money as the chart is going up. So if you buy a stock at $10, that means you're in a long position. If it goes to 20, you made money. Pretty simple.
Okay, that makes sense.
The complete opposite of that is short. A short is when you make money as the chart is going down. Again, I'll try to explain this as simple as possible. Essentially, what you're doing is this. Say if the price is at $10. You then ask your broker, hey, can I borrow 5 shares of stock at $10? I promise I'll give it back. They say, yeah, sure, why not, homie? So you now have $50 worth of short shares, 5 times 10. So what you want is price to go down, because if the price goes down to say $5, you can then buy back 5 shares at $5, totaling $25. So you got the 5 shares of stock cheaper than what you borrowed them for. You then do a little switcheroo, give the shares back to your broker, just like you said you would, and then you can keep the rest of the profit. So in this scenario, you would have made $25 as the chart was going down. Hopefully that makes sense. So big picture, long positions, you make money as the chart is going up. Short positions, you make money as the chart is going down. Next is bulls and bears. If you're completely new, you've probably have heard traders say this before, and you thought to yourself, why are there animals in the stock market? Yeah, it's weird. I don't know, but it's the lingo. So basically, if you're a bull, that means you think the market is gonna go up in the future, or you take long trades. So oftentimes you'll hear,
oh, there's good market news today, I'm bullish.
If you're a bear, that means you think the market is gonna go down, or you take short trades. An easy way to remember this is when a bull charges at you, they swing their horns upwards. When a bear claws at you, it goes downward. See, you're a professional trader already. I am! Next, we'll talk about the spread, and this is when it starts getting really juicy. But before we get into that, let's talk about today's sponsor, Hanker Trade. If you're a new trader and haven't heard of Hanker Trade, you need to look them up. They are who I use as my personal Forex broker, and there's a reason for that. One, they're pretty hot. All jokes aside, they're awesome. Low fees, low spreads, which is what we're about to go over in this video, and they make it extremely easy to execute orders. The reasoning why I think they are so good for beginner traders is because they basically help fund your account when first starting out. If you use the link in my description, Hanker Trade will match whatever you first deposit. So if you put in, say, $100, they will literally give you $100. I've never seen another broker do that. They're awesome. I'll put a link in my description, go check them out. All right, let's go back to the juicy information and cover what a spread actually is. In trading, there's basically 2 main prices, the bid and the ask. The bid and ask refer to the prices at which buyers and sellers are willing to trade the stock. The bid price is the highest price that a buyer is willing to pay for a stock, while the ask price is the lowest price that a seller is willing to accept for the same stock. For example, if a stock has a bid price of $10 and an ask price of $11, this means that a buyer is willing to pay up to $10 for the stock, while a seller is willing to sell that same stock for at least $11. The difference between the bid and the ask is called the spread, which represents everything in the middle. Oftentimes when you watch professional traders during live streams, they'll have this moving data on their screen, and it'll make them look really cool and professional. Well, this data is actually called level 2 data, and these moving numbers are the bids and asks. So these numbers on the left are the bids, so you can see here, the highest price someone is willing to buy the stock is this price, and this number is the amount of shares they want to buy. The numbers on the right are the ask price, so this number right here is the lowest amount someone is willing to sell this stock at. The amount between these two numbers is the spread. While we're on this topic, let's talk about the different types of orders. So when purchasing or selling a stock, there are different ways you can do it. I'm gonna go over 4. There are more order types than this, but these are the main 4 you should know. There's market, limit, stop, and stop loss. A market order is you basically saying, I want the stock right now, no matter what the ask price is. You want the broker to instantly buy the stock at whatever the stock is at right now. The pros of a market order is that you know for sure you'll be in the trade no matter what. But the con of that pro is you're essentially paying a premium because you're buying that stock for whatever the ask price is right now. A limit order is you basically saying, if the stock hits this price, I want to buy it. So say for example, a share of stock is at $50. You can put a buy limit order for $40. This means your broker will only purchase that stock once the price goes down to $40. Once it hits 40, it'll purchase it automatically. The pros of a limit order is that you're essentially getting the stock at a cheaper price. But the con of that pro is you may not get filled because there are going to be some scenarios where the price doesn't go down to your limit order and you'll miss out on the trade. Next is a stop order. A stop order is kind of the opposite of a limit order. Essentially, a buy stop order is you saying you only want to enter a trade if the stock goes up to a certain price. For example, if you have a stock consolidating or moving sideways in a range and the top of this range is at $50 and you only want to enter into the stock once it breaks that range at $55, you would create a buy stop order for $55. Once the price breaks this range and reaches $55, your broker will then purchase the stock. Next is the fourth and final order type, which is the stop loss order. And this is arguably the most important one. Unlike the three other orders where it enters you into a trade, a stop loss takes you out of a trade. So say the price is at $50. You're in the trade, but you say to yourself, if the price ever goes down to $40, I don't want to be in the trade anymore. Well, what you would do is set your stop loss at $40. If price ever goes down to that point, your broker will automatically exit for you. So little recap. Market order is you want to buy the stock right now, no matter what the price is. You want to enter instantly. A limit order is you want to enter if price ever goes down to a certain price. A stop order is the opposite of a limit order, and you want to enter if price ever goes up to a certain price. And the stop loss is you want to exit if price ever goes down to your stop loss. Now, like I said, it can get a little bit more complicated than this, but for the sake of this video, these are the 4 order types you should know. These are the absolute basics, but it's kind of one of those things that's a little boring, but also one of those things we had to go over. To be honest, if this series was an A to Z series, we haven't really even passed B yet. My goal with this series is to slowly get more and more advanced as we progress throughout the series. So that way, by the time we get to the Z video, you're basically Einstein when it comes to trading. So